It is now time for Your Money. We're joined by John Nelson, financial advisor at NelsonCorp Wealth Management. John, welcome back.
Thank you, Redrick. Happy to be here.
All right, so 2020 obviously full of lessons for investors. So as we move forward in 2021, are there any of those lessons that you think are particularly relevant right now?
Yes, lots of lessons learned in 2020. One of the biggest ones is the dynamic that we look at with clients that, reaching for yield. That's the dynamic where investors are in a place at a particular time where the return that they're getting from current investments aren't quite what they used to be. Think of CDs, think of bonds, where now I'm getting next to 0% in interest, and they're looking for other options for higher rates of return. But by doing that, oftentimes taking on more risk than they may be realizing they are. So, for example, you look at CDs. If I'm a CD investor getting next to nothing in interest rates, unfortunately, right now, moving out on that spectrum, maybe stepping into government bonds, corporate bonds, even some stocks in some cases, and just making sure that those who are reaching for yield understand many of the risks that they are taking on by doing so, and how those dynamics can play out for them long term, especially for those investors who may not have invested in, say, slightly higher risk type investments. They've been in CD and bonds their entire life. We've seen that dynamic play out with a lot of retail investors over the last few years.
Sure. Do you have a specific example of that type of risk playing out? Sure.
So a graphic that we have with us today is just looking at the yield. So in the blue, we've got the S&P 500 high dividend index versus the red line, which is just the S&P 500 index. So many people think that higher yield means more return, and it most certainly does not. Yield is not return. And as we can see in this graphic, from 2016 through 2017, the blue line, the higher dividend index, was outperforming the broad-based S&P 500. But those were periods of time where there was very little volatility, no significant market events, and things can play out in that manner. This is very typical for what we've seen not only over the last 5 years, but looking decades before. You can see that crossover where the red line then begins to outperform when market events take place, volatility picks up in the market. You see a dramatic outperformance, especially in 2020 when the pandemic struck, where the high dividend index, which many people would think as a good thing, or a broad-based market or an index that would outperform those that are not paying high dividends. But that's simply not the case, where they're under 50% of the return that just the S&P index itself without the high dividends. So this is a dynamic, like I said, it is not unique to the last 5 years, or especially in 2020. This has played out many times before. So just investors understanding that yield is not rate of return. We much rather look at total return, which takes into account the yield as well as the price movements.
So what can people do to avoid falling into this trap?
Yeah, I'd say just what I stated, understanding the difference between yield and total return. The yield often means, if it's paying a higher yield, that means you're taking on additional risk, and that's very important for people to understand. There's a lot of high dividend paying stocks that went into 2020 that ended up cutting or totally eliminating their dividend, while the stock price is down 30 and 40% still. So those high dividends sound appealing and are certainly great in low volatility environments. But when you go into higher volatility, market events take place, just knowing what you own and why you own it, and total return is a far better proxy than simply looking at the yield.
We appreciate the good advice as always, John Nelson. Thanks for joining us.
Thank you, Redrick. Happy to be here.
All right. If you miss any of our discussion, we will make it available to you at ourquadcities.com.